Hi, everyone. Welcome to the Week in Charts, where I cover the most interesting charts and themes in markets and investing. Big show this week, a lot to talk about. We have new inflation data, we have commodities spiking, we have consumer sentiment plunging, we have the risk of U.S. recession rising. The Week in Charts is brought to you by my friends at Y Charts. Take a look at the show notes to receive a link to a free trial and 20% off when you first sign up for the service. So I want to start out with this concept, and this is a saying that I like to say, which is there is no impossible in markets. So the past few years, we've seen this time and again. We've seen negative interest rates, negative crude oil, and now the reverse situation where commodities are spiking to the upside. So if someone would have told you 2 years ago that gasoline futures would be hitting all-time highs, you would have said they were crazy. The world was shutting down. We're entering the early stages of the pandemic. Demand was collapsing, and the outlook seemed pretty bleak for gasoline, the commodities market in general. And what we have just 2 years later is a spike here to all-time highs, surpassing the prior high from 2008. So the big news last week was the U.S. announced a ban on Russian oil in terms of imports. And as soon as that announcement was made, you saw the price of crude oil spike. You saw gasoline spike. And we're now seeing the highest prices at the pump ever in U.S. history. So $4.33 a barrel now in the U.S. That's higher than the 2008 high, which was $4.11 a barrel. And what people are talking about, and a lot of people are talking about prices at the pump, is what will this do to demand? Will the consumer start to pull back? And will that pullback cause a broader recession in the US? So let's dig into that concept and let's look at some data and some prior examples. First, with the price of crude oil. So how unique is the spike in crude oil over the last 12 weeks? It's pretty rare to see such a sharp move higher. So at the bottom here, we're looking at the 12-week rate of change. So the 12-week change, percentage change in the price of crude oil. And as you can see here, 75% increase, and that's only happened 2 times in history. So we have crude oil data, futures data going back to 1983. That's when futures started trading in crude oil. Only 2 other times in history do we see such a large spike. The first was in August 1990 when Iraq invaded Kuwait and the price spiked. And the second was following the pandemic lows where crude oil was rebounding and you just saw a huge percentage change over a 12-week period. So this is now the 3rd time in history we're seeing such a large spike in a short period of time. And of course, investors are asking, well, which of these 2 comps applies to today? The lesson we've learned is that every time is different, but if we're going to pick one of the 2, we'd probably have to say the 1990 example is more appropriate because we're not in a recession yet. We're not coming off record lows in the price of crude. We were at elevated levels before this recent spike. And the concern is that it's going to lead to something that we saw in 1990, which is a recession that began in August 1990 when that we saw that crude oil spike that lasted until early 1991. So in terms of recessionary indicators, this is a chart that we looked at last month, and it's gotten worse since then. So this is a chart of consumer sentiment in the US. So just asking US consumers how they feel about current conditions, how they feel about spending, how they feel about the future. And as we can see here, this index has really collapsed in recent months. And this was the case even before the Russian invasion of Ukraine. We saw a decline, and a lot of that was due to higher prices and the threat of inflation, and consumers are concerned. And so what we can see in this chart here, looking back at history, is only a few other times were we this low, and 3 out of the last 4 times that had happened, you were in a recession. So in the 1970s, where you had high inflation like today, you had a recession. Early 1980s, similar situation. And then during the financial crisis, 08, 09, you had very, very bad consumer sentiment. The exception really to that rule was in 2011. There was a bear market in US stocks. A lot of people thought maybe there was going to be a double dip recession in the US. It didn't end up happening. And you had consumer sentiment briefly collapse and then recover. So the fear today is that this is an indication that the consumer is going to start to pull back, that there's a tipping point essentially where rising prices cause then a decrease in demand. We haven't seen it significantly yet in terms of the retail sales data. We've seen it decline on a real basis. We'll get more data on that this week. But that's the concern, that the high price of gasoline, the increasing prices of food, as we'll talk about later, the increasing price of just about everything is going to cause the US consumer to start pulling back, and that in turn will cause a downturn in the economy. So in terms of what people are thinking, I put this poll out here. What are you thinking in the next year? Will the US go into a recession? As you can see, the overwhelming majority say yes. And perhaps that's just a function of the negative news today. But I think many people within the country now are concerned that this inflationary issue is going to persist. And that concern may start to lead to a change in spending habits. It may have already begun, and we just haven't seen the data yet. So this is where sentiment is. And you could say that perhaps they're wrong and this is a contrarian signal. But I think it's interesting. You typically wouldn't see this number this high, given where we are in the economy, which is still growing, and earnings, which are still growing as of the end of last year. You wouldn't see such a high percentage of people believing that we're going to recession. But that's where we are today. I think part of this also is the declines in the stock market, as we'll talk about. So that tends to have a large impact on consumer sentiment as well. And we saw that in the 2011 example, where there was no recession, but stocks were down. And that has an impact. People feel less wealthy when stocks go down. And so they naturally assume that means the economy is weakening. So interesting data point. We'll see. Obviously, the risk of recession is much higher than it was 12 weeks ago. Or is it enough to push the US economy into recession, or will it just be a brief downturn? We'll get more data and evidence on that in the coming weeks. So what is the big concern for the US consumer and people in general here? This is something that we've been talking about month after month. The biggest concern is really a loss of prosperity, a decline in purchasing power, where inflation outpaces the increase in your wages. And this is a valid concern. And if we look at the data, this has been going on for 11 months now. So this is a chart showing the real average hourly earnings, the year-over-year percentage change. So what we've been seeing, and you don't want to see this, is it's below zero now for 11 straight months. So in simplest terms, what that means is your earnings have been going up in the US, wages have been going up, which is a good thing. The problem is the prices have been going up more. So the changes in inflation have outpaced the changes in people's earnings. And when that happens, you feel poorer. And when it first happens, it's hardly noticeable. But when it happens now for 11 straight months, you really start to see it. Your wages are just not keeping up with the prices that you see in the supermarket every week, at the prices when you fill up your car with gas. Obviously, wages are not going up fast enough to keep pace with those increases. So we got the February CPI report last week, and what it showed is really a continuation of the trend. And keep in mind, this is before the recent spike in commodity prices that happened in March. So the expectation is you're going to see an even bigger number in March. But the February number was pretty big by itself. We saw a 7.9% increase in CPI. This is the highest we've seen in 40 years, since early 1982. And if we take out food and energy, similar increase is the highest since 1982. So where are prices going up? If we're looking at the CPI report, pretty much everywhere. So there's been really no part of the economy that's been immune to this increase in prices. We're seeing it pretty much widespread. So fuel oil up over 40%, used cars still up over 40%, Gasoline, obviously, that number is going to be much higher when we get the March report, 38%. And food at home, this is a big one, 8.6% higher than the overall rate of inflation. So just going to the supermarket, especially if you're buying proteins, meats, fish, poultry, eggs, you're spending much more than the overall CPI. And then here, this is an important point at the bottom of the list. This is the largest component of CPI. The biggest single expense for most Americans is housing. So the shelter component showed a 4.7% increase year over year, which was trending up. But you'll probably look at that number and say, how is it possible that prices of housing have only increased 4.7% when we're seeing a housing boom and rental boom? Well, as I've been arguing for months now, this is severely understating the actual increase in shelter. So the way they arrive at this number is by polling people and asking them and not looking at actual data. And what does the actual data show? It shows the biggest increase in U.S. rents in history. And so up nearly 18% over the last year. And if we use a number like this, or if we use the actual increase in home prices, what you would see is an actual inflation rate that was over 10%. So if we're looking at that 7.9%, as bad as it is, it's likely understating the actual rate of inflation in the US. So what that means, of course, is that the rate hikes are coming. And so a lot of people have been dismissing this notion, saying the Fed won't move, they're not going to hike rates, they're going to try to keep this thing going. But I don't think they could ignore that inflation problem any longer. And why is that? Well, just looking at Fed policy, it's so out of whack with where the inflation rate is. And this is one way to look at it. If we look at the real Fed funds rate, so if we take what the Fed funds rate is, which is effectively zero, and subtract CPI and look at that over time, we have pretty much the lowest rate in history. So you have to go back to 1974. We had a single month where it was lower than today. So what this means is monetary policy is extraordinarily easy today, given where the rate of inflation is. And unless you want to be totally dismissive of the inflationary threat, which the Fed, of course, has been, you have to start normalizing rates. You have to at least move off 0%. So the rate hikes are coming. The expectation is that the Fed is going to hike rates this week for the first time, and they'll continue to hike until year end at every single meeting. So the current expectation, and this could change, is that the Fed will hike around 7 times this year, and that will bring the Fed funds rate closer to the inflation rate. So normalization is coming. And here's another table showing you why the Fed needs to hike. It's just a real disconnect between where employment is, where inflation is, and where the Fed funds rate is. So if we look back in the past at prior times where the unemployment rate is at 3.8%, you could see various Fed funds rates. We never saw the inflation rate this high with the unemployment rate this low. But if we look at the real Fed funds rate, nowhere near where it is today. So this is a historical outlier that we really have never seen with the unemployment rate this low and inflation rate this high. And for all those reasons, the Fed is going to move despite the turmoil that we've seen in markets. So normally when you have this type of decline in the market, the Fed would pause, they would hold off on hiking rates, but they're so far behind the curve that they have to move anyway. They have to move in spite of the weakness in markets. And then after that first hike, it'll be kind of a dance between what's going on in the markets and the economy and what's going on in the inflationary picture. So if markets just completely collapse and we see that risk of recession rising, you'll likely hear language from the Fed saying that they're going to slow down or even pause on the rate hiking cycle. But if that doesn't happen, then you'll see a continuation, likely a hike at every meeting until they get closer to that inflation rate. So if we look at the bond market, what's been the impact of this? Well, it's been painful. So we've seen interest rates across the board from short-term rates to longer-term rates rising to levels we haven't seen since before the pandemic. The 2-year Treasury yield is just rising very fast on the expectation of multiple rate hikes. And what we're seeing is bond prices really collapse. And so going back to 1986, this is now the longest at 581 days and largest at 6.6% decline we've seen in the US bond market over that period of time. So in bond market world, this is akin to a crash. So this would be akin to at least 20, 30, 40% decline in the stock market, this type of decline in the bond market. You just don't see that very often. And if the year ended today, it would actually be the worst year in history for the US bond market, with a decline of 4.8%. So before this year, the worst year ever was 1994, negative 2.9%. Interest rates rose sharply that year, and bond prices declined. But what we've seen in the first 2.5 months of this year is really something we haven't seen in recent history in terms of the losses in the bond market. So let's talk about another real bear market. So if we want to talk about big declines, we have to go, of course, to the stock market. And if we looked at the S&P 500, we're not quite there. The maximum drawdown in the S&P this year from peak to trough, if we look at intraday prices, was a little over 14%, but other markets are down much more. And if we look at the NASDAQ 100, which is an important index, a lot of people, the best performing index by far over the last 10 years, if we look at the equity market, a lot of money invested there. These are the biggest companies: Apple, Amazon, Microsoft, Google, and all in the NASDAQ 100. And it just entered a bear market, down over 20%. So this is a chart going back to the inception of this NASDAQ 100 ETF, looking at the drawdowns over time. And as you can see, this was the pandemic crash. Very quickly went down and then quickly recovered. The 2018 bear market was a few months in duration, quickly recovered. And then before that, we have examples where it did not quickly recover. So the following the March 2000 peak, you had an over 80% decline in the NASDAQ 100. It took a long, long time before the market would recover and hit new all-time highs again. So what people are, of course, asking, is this going to be 2018, 2020 again, and we're going to recover, or is it going to be a longer, tougher bear market where valuations really go down and stocks really reprice? And of course, no one knows the answer to that. But the fear is, of course, that we won't see a buy the dip mentality, and this is going to drag on for some time. If we look within the NASDAQ 100, is that 20% representative? And so there's obviously some debate there. You have stocks like Apple holding up much better, and that's kind of masking bigger weakness within many of the names in the index. So I just quickly put together data from Y charts. We're looking at the largest percent below their all-time highs within the NASDAQ 100 index. And as you can see, there's a number of stocks that are down more than double what the index is down, and a couple of big names. So if we look at Facebook, which now goes by Meta, and Netflix, they've been nearly cut in half. So big declines. We're seeing a bigger repricing in the higher growth segment of the market than the overall market. And we've been talking about that, but that's really continuing. So the view of market participants is, if interest rates keep rising, if the inflation threat persists, that's bad for higher growth stocks, because that future growth is worth less today. If you're discounting that growth using any kind of discounting model, you're plugging in a higher interest rate, and it's just less valuable today, that prospect of future growth. In addition, the same time that's happening, you have a slowdown in that growth rate. So a number of these tech companies pulled forward demand in 2020. And now you have that natural slowdown that was going to happen. So if we look at stocks like Zoom or Peloton, that's the extreme example, where obviously they had this huge growth rate during the pandemic, and then when the pandemic starts to wind down and people start to go back to the office and then go back to the gym, the growth rate comes back down. But we're seeing it in broader, just in technology in general. So there's just this huge investment in technology in 2020 for good reason. People never relied on it more than that particular year. Multiples went up, growth rates were huge. Now you just have a natural deceleration. You can't continue to grow at that high of a rate for that long. And so we're seeing that pretty much across the board within the tech space. And so we're seeing broad repricing as interest rates rise. And this was an interesting chart that I think would surprise a lot of people, looking at Facebook and IBM. And so Facebook's P ratio is down to 13 versus almost 20 times earnings for IBM. Facebook, of course, has always been viewed as a growth stock. And then IBM maybe more of a value stock. I don't know what you would call it, but certainly hasn't been growing much in the last decade. But now you have a situation where that's kind of been flipped, and Facebook may be entering the value realm. So I wouldn't be surprised if the damage continues here to see when these indices get reconstituted quarterly, if Facebook is now admitted to some of these value indices. So growth becomes value, value can become growth. There's no static definition in terms of this stock is always a growth stock or always a value stock. They can evolve over time, and investors appear to be saying that Facebook's growth is slowing enough where it should be priced more like a value stock. So just an interesting thing to see how quickly Facebook moved from being a high growth stock to now closer to a value stock. In terms of the broad market, I went back and looked at how the start to 2022 compares to prior years. And it's been a pretty bad start to the year, but how does that compare to history? So I went back to 1928, looking at the first 48 trading days of the year. So the S&P 500 is down 11.8% this year. That would be the fourth worst start to a year in history. So if we look back since 1928, we only had a few years that did worse, 2009, 2020, 1935. And if we looked at the top 5 worst years before this year, 2009, 2020, 1935, 1933, and 1982, the interesting thing is every single one of those years mounted huge comebacks. So I guess if you're bullish and you're hoping for a reversal here, maybe you could point to some of these years and say, well, again, there is no impossible in markets. Perhaps we could see another monumental comeback this year. Of course, the other side would say, well, there's many differences between this year and those years. We have higher valuations today than any of those years. We have inflation rising faster today than any of those years. In terms of looking at inflation, if we look at 1982, that was coming off peak levels of inflation, coming out of a recession at that point in time. And so you did see that recovery, pricing that in. And so different scenario there. Obviously, during the pandemic, we had that incredible reversal in terms of we saw just that unbelievable amount of stimulus from the federal government and from the Federal Reserve. Is that likely to happen here? Well, we know the Fed is moving the opposite direction, at least this week, and that might continue. And there's more reluctance in terms of issuing additional debt to do another round of stimulus today. So hard to say that's a comp. If we look at the 2009 example, that was, of course, the low and a long bear market for stocks. The multiple is much cheaper. You're coming out of a recession there. And then 33 and 35, that 33 is the tail end of the Great Depression. So obviously different scenario there. Same thing, 35, you're still bouncing back and forth with these huge swings in stocks. So not impossible to see a comeback this year, but to argue that 2022 is similar to any of these other years and therefore we'll see a similar increase, I think that's a hard case to make. The fear is that we're going to have another 2008, so that this dip is not bought and that stocks really have to reprice further. and perhaps we're heading into a recession. I guess that would be the real bear comp if you're going to look back in history. And obviously, you don't want another 2008 example, but that really stands out in terms of a bad start to a year continuing. And so I polled Twitter asking, do you think the S&P will finish higher or lower than it is today? And interesting, this kind of surprised me. I thought we'd see more of a bearish reaction just given what's going on in markets, but more people actually said the S&P would finish higher than lower. So we'll revisit this at the end of the year and see if people were right. So, but there's still some optimists out there thinking that we could at least recover, even if we don't see a huge comeback like we saw in these years. There seems to be enough people saying that stocks will at least come back to finish higher than today. So this is an important point, I think, that is lost when we talk about valuation. Valuation is hugely important, and it's highly predictive of long-term outcomes in general. So the price you pay matters. And in general, a security that is priced cheaper, all else equal, will have a higher return than one. And on average, again, taking a basket of stocks will have a higher return than something that's extremely overpriced. But this is not absolute. And you see many examples throughout history where valuation becomes meaningless. And I think what happened in the Russian stock market recently is an important example for investors to really understand. So this is a chart showing the CAPE ratio of the US versus Russia over time. And at the end of February, the Russian stock market had a CAPE ratio. CAPE ratio, for anyone who doesn't know, is just a smooth PE ratio. So instead of taking 1 year of earnings, you take 10 years of earnings and you adjust for levels of inflation. So it's essentially a PE ratio, but using longer term earnings and an average of longer term earnings. So at the end of February, you have the Russian stock market trading at a CAPE ratio of 7, which is among the cheapest markets in the world, versus 35 for the US. And so if you were just a value investor and you said nothing else matters other than the valuation of a security, you would say buy Russia, right? Don't buy the US. Maybe don't short it, but at least avoid the US because it's among the most highly valued markets in the world, and Russia is cheap, and there has to be an opportunity there. And in most cases, that would be right, and that would be the right way of thinking, but not in the extreme example. So what actually happened, since the end of February, is a week later, U.S. stocks were down 1%, and a week later, if you're looking at Russian stocks from the standpoint of a U.S. investor, you have a pretty much complete loss. So if we look at the Russian equity ETFs, their net asset value when they stopped trading at the end of that week, a week after the end of February, the net asset value is essentially zero. So you're almost wiped out, on your investment in Russian securities. And were they cheap? Of course, they were cheap on a numbers basis, but that didn't matter because the securities were effectively banned. They were, as we talked about last week, they were removed from indices. You couldn't trade these stocks anymore. The Russian stock market's been closed since February 28th. So investors in the securities, we don't know if they'll ever trade again and what they'll end up receiving. But it could be close to zero if the net asset value is accurate. So just an important thing to think about. Valuation often matters, but at the extreme, there can be times where it proves meaningless. And if a security is banned or you can't trade in a market, it doesn't matter what it's worth. For you, that's a complete loss. So someone ultimately might step in and buy, let's say, Gazprom or some of these Russian companies, make investments at distressed levels. But as an individual investor, you're not likely to be able to gain access to that type of purchase, right? So This is one example, but if you look at any individual stock before it goes to zero, so a company that's going bankrupt, it's going to look cheapest right before it hits that zero mark. So it's just a cautionary tale. Just because something goes down and looks cheap based on a multiple, it doesn't necessarily mean it's a good purchase. So this historically has been known as a value trap, where it looks cheap on paper, but there's a reason why it's cheap. It's because the fundamentals are just so bad that you're not going to make a return on your money. Or in this situation, Russia was cheap because it was in part likely pricing in this fat tail risk, which ended up happening. So last thing I want to talk about is go back to commodities and talk about nickel. And so nickel's not really a commodity most people talk about. Usually it's used in many different things, but people don't generally talk about nickel when they're talking about commodities. That changed last week when nickel did this. So looking at this chart, it almost seems like it's made up. During the course of 2 days, the price of nickel it doubled, then doubled again, and just an extreme move that we haven't seen before. And what's going on here? Well, it really started with fears of Russia not being able to export their products. Russia's, I think, the third largest producer of nickel. They have one of the largest nickel mining companies in the world. That production, the thought is that production is going to go down. If we're banning trade with Russia, that's going to reduce supply, and that's going to lead to a shortage, and prices will spike. So all of that was true, but you take a concept like that and you push it to the extreme, and that's what happened in the nickel market. And the London Metals Exchange, which is where this is trading, did something they haven't done since the mid 1980s, which is they suspended trading in nickel because of this huge advance, and someone was on the wrong side of this trade. So that someone, we learned, was this huge Chinese producer, this company that was short nickel, and this is a pretty bad short squeeze, and people are saying that the estimated loss is around $8 billion. So they suspended trading. They're trying to sort that out. So it could be knock-on effects here in terms of losses and other people losing money from this trade. I don't think we know the full story yet, but just a multi-standard deviation event beyond what was the actual true fundamentals. So yes, is Russia's pulling back from the nickel market likely to lead to an increase in pricing? Does that make rational sense? Yes, but should the price triple in the course of 2 days? Probably not. But so you just have the situation where you have the short squeeze, as we've seen with GameStop and other securities, where the supply demand imbalance is just so huge that prices go to irrational levels. So nickel is now trading again this week, and we've seen the price come way down. We'll see where it settles out. We'll see what the knock-on effects is, but just a huge fat tail event. And we'll end with this chart of, this is the nickel ETN. And during one of those trading days last week, it's up 69% in a single day trading day. That's a 40 standard deviation move based on the historical move. So once again, a move like that, and we've seen many of them in the last 2 weeks in markets, move like that should never have happened in the history of the universe if the markets followed a normal distribution, but of course they don't. And this is the latest example. I'm sure in the next few weeks, we're going to see many more. So that's it for this week. Thanks everyone for joining us, and we'll see you next week.